A monster red alert on inflation. The consumer price index for October clocking in its biggest year-over-year gain since 1990. That's more than 3 decades ago. Stocks pulling back sharply on this news with major averages closing near their lows of the day. The Nasdaq down more than a half a percent, and a half. And check out the moves in the other markets. Treasury yields spiking with the 2-year climbing back toward its highest levels of the year. The dollar at its highest since August 2020. Gold jumping to its highest price since June. So does today's data prove that inflation is more than just transitory, and to take it one step further, that the Fed might actually consider raising rates faster than what we had been anticipating, Tim?
Yeah, and we're underestimating the impact of housing, and I think this is something that people don't really understand, that the inflation is actually significantly higher than what we're getting here. But services component of this number, massive. And so if you look at the core, you were 5.4 now on an annualized when you strip out where we were on the headline. We were at 4.2 essentially a month ago. I realize there's some choppiness in here, but this is really where the stuff is. These are exclamation points. I mean, these are numbers that are not, again, central banks have one of two mandates. Some have two, some have only one. The ones that have only one are there to fight inflation. Ours has two. The other is to stimulate growth. And they've created a bubble here. And we just have to really be vigilant to see which parts of the next wave of inflation are coming, because labor inflation is not showing any signs of being transitory. Some of this, what makes it complicated is this is a very important social issue, right? If you think about where labor has been earning and wages have been for minimum wage earners and for lower demographic groups, it's been impossible to make a living wage. I mean, this is a social issue. This is an issue that's not changing anytime soon. And so good for those that are now making a living wage, awful for the economic outlook for at least where inflation is.
Yeah. Pete, what did you make of the numbers? And are we back in a world where, yields go higher, tech stocks are challenged, and here we are bouncing back and forth?
To some degree, I'm still not so sure that the tech stocks have to take the beating that we saw today. As a matter of fact, you look at the Nasdaq down 260. So obviously there's a lot of different names within that, but they were under some hammering. But I think the interesting thing is, I think we should have expected to see sort of a number somewhere close to what we got today, Mel, because let's be honest, over the last year, we've watched oil prices go from, literally a year ago, 38, all the way up to 85. Even just over the last month or so in October, we went from 77 to well over 80. So, we should have expected some of this. And it's not just crude, it's copper, it's natural gas. You go across the board. Tim talked about wage inflation as well. I mean, we're talking about a lot of different areas of the marketplace that are somewhat. I've not bought into this whole idea that this is transitory. I think this is something we're going to have to work through, and obviously the Fed is going to be a part of this whole thing. So I do sort of think right now that we are in a very, very gingerly sort of interesting spot, because when you look at the volatility index, even while we were going up, the markets were going up and were record numbers not too many days ago, just 2 days ago, we're looking at volatility starting to pick back up again. And here we are today. We actually are back there in the mid-18s to upper 18s, and we're a sneeze away from 20. And I think that's something that we all have to keep an eye on as well, the volatility index, because that's going to give us a measure of some of the concerns that are out there, as well as the kind of movement to be expected.
Well, also on the move on the back of the CPI print, crypto, Bitcoin, in fact, hitting its highest level on record, just shy of the $70,000 mark. Many seeing cryptos as a hedge against inflation. So why is that? Trade school's in session. Professor Feinerman is at the head of the class. So Karen, take it away.
Yes. Well, why is it? First of all, it appears to be a hedge for inflation. So institutions who do think there is inflation have decided, all right, we got to have exposure to Bitcoin anyway. We have to have exposure to cryptocurrency. It used to be like some would just venture out slowly. Now it's sort of, if you don't have it, that doesn't look great. So that's part of it. The other thing is inflation. I mean, for crypto, for Bitcoin in particular, by its very design, was hopefully, when they designed it, to protect against inflation that all fiat currencies have had over time, right? That's always the downfall of a fiat currency, is inflation. And Bitcoin, by its design, there are only 21 million coins that will ever be created. And right now, 18 million or so, I don't remember the exact number, have been mined. So it doesn't, as a currency, it doesn't have that ability to inflate by printing more. And then the third reason why it's going up is just all assets seem to be going up, or at least they were until when we talked about it with producers maybe around 2 o'clock or so. I'm not sure exactly. So, but all things seem to be rising. Gold, Bitcoin, stocks, housing, everything.
Steve, what's your inflation hedge of choice?
Yeah, so I would be a buyer of companies. Pete started the conversation off with companies that are asset heavy. So all those commodity-based companies. So I'm long those names that I've talked about for a while now: Trinseo, WRK, which is WestRock. You could even dabble in a DOW, which is a chemical name. So they have the ability to have pricing power. So they want to raise prices, and they have the ability to raise prices quicker than the actual input cost as that's rising. Obviously, you don't want to be a buyer of tech companies because you're paying for that future cash flow. And if that future cash flow is worth less in the future, then the stock should, in theory, trade lower. What we haven't seen, though, is any real push in that 10-year yield. So it's thrown everything on its head right now. So unless the 10-year yield starts pushing higher, 2% or above, these value assets or value bucket are just going to kind of move sideways until we actually see some real explosion in this temporary transitory inflation environment.